You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Hello and welcome, everyone. Welcome back to the China Shop. Come on in. We got an exciting bonus episode for you today. With me, as always, is Kyle, creator of financialineptitude.com. How you doing, Kyle?
Good. Feel like we just did this.
We did just do this, but you know that's an okay thing. And with us today, joined, we're very excited. We have George Papazov from TradePro Academy, TM. How are you doing, George?
Yeah, that's me. Hi, guys. Thanks so much for having me on the show. Very dangerous for me to be in any kind of China shop. I do everything forcefully without any tactic.
You fit right in.
You fit right in.
I'm pleased to be here. Thank you guys for having me. We're going to have a great chat. I'm excited about it.
Why don't you tell us a little bit about yourself then? What do you do? What's your trading strategy? How'd you get involved in it? That kind of stuff.
Yeah, for sure. So I started trading in 2001. My parents immigrated to Canada, where we still live at the moment. I'm in Toronto, actually a suburb west of Toronto in Mississauga. But you know, on a more like broader scale, we immigrated to Canada. My parents gave everything up they had in Eastern Europe to come here in this country. You know, I always kind of hustled. I always looked for ways to make money on my own terms, on my own schedule. You know, working for somebody wasn't really what I wanted to do for a long term. And back in the day, you know, that was kind of nuts in 2001. The way entrepreneurship's evolved now, to work for yourself isn't even perceived to be crazy, but back then I was crazy.
Right.
So I got through like financial education, I got into the trading desk at Scotiabank. It's one of the big six banks here of Canada. There I started in customer service right in 2009. So, you know, in the meanwhile, from 01 to 08, I was writing financial blogs, putting out about a bunch of content, trading currencies. And then 09 hit, you know, everyone was losing money.
Oh, yeah.
It was really difficult. Like, I had phone calls that were very dark, people telling me that they were going to take their own life.
Oh, my God. Oh, jeez. Really?
Yeah, we had to dispatch like police and compliance. Oh. Yeah, it got very dark. And so I'm sitting there having these calls, and at the same time, I'm putting out education, telling people, you know, in fact, I was warning them of this impending collapse on these over-leveraged products. And then I'm dealing with it. I'm like, I'm letting people down. So I really quit. I became a trader in 2012 for Scotia, officially licensed. I was customer service up to that point. And then I quit the bank in 2016 to pursue doing this full time. And what we do is we empower and educate individual investors to help them take the approach of professionals, but apply it to their independent trading. You don't have to be in a Goldman Sachs to trade like a professional trader. You could mimic a lot of the characteristics and behaviors.
So are you more of a day trader then, or short term, long term? Like, what's your typical strategy that you go after today?
Oh man, I've kind of done everything and anything. I've traded everything except cryptos, to be honest with you. But I started out with currencies, then I did options, and then at TradePro Academy, we have a couple traders that are on the books. So we trade both options and futures. I actually run the futures day trading front, so I'll trade things like equity indices, S&P 500, oil, gold futures as well. But all of it is day trading basis. So I'll wake up in the morning with cash. I'll put on some trades, you know, in the first 2 hours of the session, 9 to 11 a.m. Sometimes I trade later, but the later I trade into the day, the worse I'm trading. So I like to finish within 2 hours. And then when I'm done, finish in cash, hopefully more than I started with. And then I go to bed without any risk. So that's kind of my approach and strategy to trading.
Oh, yeah. There's nothing worse than having a long weekend with some options contracts that you don't know what's going to happen Monday morning.
Oh, yeah.
Yeah, nothing like this job to appreciate a Monday, right? Yeah. Like, you love Mondays in this job. Like, here we go.
Oh, that's funny you said that. Yeah. That's kind of interesting, too. You said you started with currencies and then... It's like the backwards way. Most people start with stocks, then go to options, then into futures and forex.
Like I said, I'm surprised I'm invited to a China shop, but like nothing in my journey has been easy or traditional. You know, it's like I'm kind of a good motivational story for people, because if I could do it, I honestly believe anyone can. Like I've gone through basically the roughest route that you could take. You know, anything but the most polished approach. And so I started with currencies because that's what my dad had known. He introduced me to trading. And, at the time, you got to think 2001 to be able to trade online. I mean, brokerages were charging around $40 a trade for stocks, right? And you guys remember that. You've been, around the industry for as long as me, given our age. So it's like, it costs so much more money to trade stocks. In fact, to trade stocks, sometimes you had to have an account with like minimum equity requirements of 50,000 plus. It wasn't something a lot of individuals were doing. So I started with currencies. That was easy. The pound was one of the first one I traded, GBP USD cross-pair, and then gold as well, XAU USD. And then went to options because I'm like, look, I like currencies, but I don't want to either be long or short. I want to have the ability to like massage or work those positions. And that's what got me interested in options, is that continuous risk management.
You mentioned the commissions, actually. That kind of does lead into another question that I had about, but I don't want to derail us. Dan, did you have anything to follow up on that before I jump ahead?
No, I did think of your question, though.
Yes. Okay, so that was one of the things that I think you in the email that you sent us is the commission-free trading that everyone's experiencing these days. Like, we all know there's no such thing as a free lunch, right? So how are the investors actually paying for that when they're not seeing like a typical dollar charge?
Yeah, you remember, did you guys watch, what was it called, Tiger King, I think, on Netflix? Mm-hmm. That crazy documentary. Remember how he was making pizza from like scraps and from like a Walmart trash can?
Right.
Like, in a lack of a better analogy, that's kind of what commission-free trading is. It's like, if you think about it, if you're not paying for something, if you're not paying for a product, you are the product. And, that's always been my belief about a lot of things that have created value in the last decade. Like any social media, basically, right? It's like, how do we go in and post something about our day, and then this company's worth billions of dollars, but we don't really pay for it. So it's like commission-free trading, when it first came out, like if you look at how brokers make money, it's always one of three ways. In fact, usually all three of these ways. Number one is commission. Number two, it's currency exchange. So clients calling, I got 100,000 US, flip it to euro and wire it to my account. And then number three is margin lending, which is like overnight lending of long-term positions to earn a percentage for short sellers who borrow the stock. And so these are the three traditional routes. The brokerage I worked with was approximately 1/3 distributed across those three categories for their total revenue for the year. So when you look at commission free, okay, if you're not paying commission, you're killing 1/3 of the revenue source.
Right.
How are you going to monetize that? And when you're not paying commission, you're actually a cost center. You look at RobinHood, the more trades that you place, the more you would think this company is doing better because you're giving them more business. But in actuality, the more trades that are placed, the more costs that increase for the brokerage. And so how does RobinHood make money? They take those orders and they sell it on the back end to the same hedge funds that a lot of the traders are trying to bring down. If you succeeded in bringing down Virtue, the Citadels, those big companies that make, obviously an enormous amount of killing. That Citadel once said, Ken Griffin on an interview said, we haven't lost money. We only lost one day in the last 6 years. I listened to that. I'm like, he just admitted he's doing something illegal. Like, who doesn't lose money in this business?
Right. We never lose. Never.
Yeah, it's like, that's how you say I'm doing something illegal. You say that one statement. Anywho, like, I don't know. I don't want to slander them. They have resources to,
I know, right?
Go after us. Yeah, so just, it's a joke. But look at Citadel, Virtue. These are the companies that are actually providing the commission-free trading because they're the ones that are paying for the order flow. Paying for order flow means, what you put in an order to buy GME on Robinhood, that order is sold for a fraction, like half a cent, to these dark pools, to these hedge funds that take the order, and they'll mark it up by a penny and then sell it through. They'll either trade ahead of that order, they'll match that order in a way that's profitable to them. That's why they pay for it.
That's exactly what we were speculating. We talked about this a couple weeks ago. I think one of the stats that I had heard, it was a couple weeks ago, is that the average stock is held for like less than a second. It was some fraction of a second. So what that means is like every time a stock is sold, that means it's changing hands multiple times a second, right?
Yeah, and you look at GameStop on that one day when it went up to 475. Actually, it wasn't 475. It was the day it hit 100. I have the chart open here. It was on January 22nd. The total volume was 197 million shares.
On a stock with that's like 71,000 shares total, I think, right?
Exactly, 71,000 share float. That's losing $1.5 billion a year, trading at 475. It's like that day to me, nothing made sense. It's like I've been trading for 20 years now, and that's a day where I felt like a noob. I was like, all right, nothing I know is really working in this situation. So, I mean, it's a fascinating discussion, and I think that with Robinhood, one of the big learning lessons here is that when you're buying stuff, you want to be cheap, right? Like if you're going to buy a gift for your girlfriend, the exercise is spend as little money as possible with the most amount of satisfaction to her, right? Where those two intersect, that's the perfect gift. Yeah. My wife is listening. I'm probably in trouble now. But with investing, though, you're hoping to buy quality, right? Investments don't depreciate. Things that we consume go in one end, out the other. So we're motivated to save. But with a broker, I always advise, look, don't find one that's cheap. Find one that matches your trading personality. If you need quick execution, find one that executes quick. If you're shorting, you need a share float, find one that has a lot of share availability. This is one area you don't want to cheap out on.
Right.
And the other thing to Robinhood is like the gamification of it. And when you look at how it's presented, it's like click here and win a free stock. Find out which one you're gonna get. A little like spinning wheel, like Wheel of Fortune.
The confetti whenever you make a good trade.
Whenever you deposit money.
Yeah, like none of that actually helps your mentality. Like none of that helps. It's turning something and making it look like it's easier than it is. And then that's how we get these situations that hurt a lot of people. And it hurt me to see too, because I love to see young people getting in.
Right.
But I hate to see this outcome.
Yeah, that was the one thing I was most afraid with this whole GameStop situation, is that it might lead to people becoming disillusioned with it and thinking that there's no chance for, the retail investor. And, it's something that we love. We want to make sure as many people get the chance to experience it as possible. Right, Dan?
Oh, yeah, absolutely. I love that so many people have so much access that we haven't had before. It only helps the entire country the more financially savvy people are and the better invested they are. Everybody wins.
Absolutely.
Throw in a once every 100 years type plague event, sit everyone at home and give them more money than they've ever seen in the form of extra stipends to the unemployments and stimulus checks, and then now suddenly you've got a lot of people trying to trade.
Right.
You got time, you got money, and you got like a desire to do better because you're in a pandemic. And if you look at this even further, how it became a movement, you also have the motivation to go after somebody or to take away your emotions on, right? Like we've been locked up and restricted in our movement, restricted socially. The worst thing for us as human beings is to be held in these conditions, like a prison in our own mind. That when this came out, this was the tool to vent out some of that emotion. It was the opportunity to take it out on somebody. And I got a glimpse of that as it was happening. And I know that ends really bad.
It was all over Reddit. I mean, that was the majority of the people that were holding it through the entire time. Most of them were, these are my shares. You can come fucking take them from once you apologize to my grandpa or,
Yeah. It became emotional and personal.
I actually had to take a couple of weeks away from trading after this whole thing kind of settled down, because not just the emotional roller coaster of GameStop itself. I mean, during that whole time, there was any stock it seemed that had a high percentage of short was just going through the roof, and that was like a large percentage of the stocks that I had been kind of playing with lately. So, I mean, I was seeing like 40% gains in a day, and I'm like, God damn, this is not normal. My expectations are not right anymore.
Yeah, I made some Best Buy option calls that week. GameStop was going on. That it really like the success wrecked my head. Like it shouldn't have been that easy. Like you shouldn't buy it one day and sell it the next day for 800%. That's not a normal thing.
Yeah, but what's dangerous about that is that people who are just starting out assume that this is what it should be like. Right, and then it's like now they take that 800% and they're looking for a company to do 1,000 next time. Because what does everyone want? More money in every trade.
Yeah,
like 800% became nothing. It's like let me look for 1,000, 2,000, and I think this is where things became unglued in the expectation. And the sad part is, Reddit as a community, when you look at, who's actually, so here's one thing that a lot of traders, it takes years for them to learn. Once you buy something, right? Let's say you buy a stock like GME, you own it. You might think that it's going to the moon, but to get out, you're a seller.
Right.
And so this is one key lesson, that once you get long, you're actually a seller.
Yep.
And the problem is that on the way down, the same people who were saying, diamond hands to the moon, were probably selling it to the late stage rally people who got stuck at the top. And while it was a movement of sorts against the hedge funds, ironically enough, it was Reddit against Reddit when it came down to the downside. Right? On the upside, everyone's making money, but you also got to ask yourself, when everything's going up and everyone's diamond handsing, who are you buying from if no one's selling?
Right.
There's got to be somebody selling it to you, right? So these are things that I think are golden learning lessons for anyone that went through this. You're a stronger investor because you've gone through this event. I think any penny lost in participating is worth the education that you're willing to take from it. If you're not willing to learn and do it again, then it was a waste of money.
Yeah.
If you learn a lesson from it and you apply it to the future, it's education. How much do we pay to be doctors? And we can't make 800% as a doctor, right? So it's a good learning lesson, I think, as a whole.
I think you said something on your podcast, the episode I listened to last night, about you're talking about a loss, like a big loss that you'd taken, and then hoping that was not the biggest loss you ever take. And then like your mentality on that, I thought was just fantastic. Because you're basically saying like, I hope that this number now becomes meaningless to me. I hope that, the next time I'm swinging like 10 times that amount loss, because that means that my portfolio has grown by 10 times in order to be taking a loss like that. And that's just money that I'm paying for that learning experience.
Yeah, absolutely. Like if you're always focusing on managing risk, if you know when you're going to get out before you get in, if you have set exit points, set loss percentages for every trade, then losses aren't a bad thing. And so I hope to be able to take bigger losses, because that means the account balance is growing. I should be taking bigger losses over time as I grow as an investor, as a day trader.
Yeah.
So, I think a loss in itself, lost capital, like does so much damage to our psychology.
Yes.
But then we go out on a Friday night and we spend $400 on alcohol and we do that, every weekend. But, there's value there in the night of the moment. So that's the real losses for me in my life. It's like, if you're out here investing and losing money, the question is, did I learn a lesson? And if you're able to extract something from it, you've paid education. And I don't know one person, and I've been doing this professionally, like on the bank side. I have a lot of friends who are still in the professional business. I don't know one trader who started out who was green and then went, from the zero to hero overnight.
Yeah.
You see a lot of our industry is bad at this. They'll show you all these gain statements of like, look how much I made, look how much I lost. And where were those statements on the way down? A lot of people kind of hid behind that. And so one thing you need to understand is a lot of traders who are in this business professionally will share learning lessons. They'll share ideas. They'll share analysis. They'll share sources. Very few people share results because you don't learn anything from my results. You know what I mean?
Yeah.
So I think that was the danger. It was just like everything started to go, and then people are showing statements. Then people got fear of missing out. They FOMO'd in, and then before you know it, we topped out.
So I guess that answers my next question then, if it was over or not. Because there's still a significant portion in the Reddit community that's holding on, saying that this isn't done yet. Short interest reports have come out recently. I think there's another question about how accurate those numbers are.
Well, so here's the interesting part about this, Kyle. Let's say you bought it at 400, because some people bought it at 30, right? Like, let's remember how GameStop started. There was a bunch of people on Reddit who had the idea holiday sales of the PS5 and new Xbox are going to be fantastic, right? Let's take part in this investment. It's a nice short-term opportunity. It was a great idea. I like that idea. And then it became, oh my God, there's more short positions than there is shares. Let's make them pay for that. But what if you bought 400 at $400 a share? It's down to 52. It might not be over, but you don't have any more money to buy anymore at 52. It might be cheap compared to what you bought it, but when you've already bought, you're not really a market participant anymore. It's who's the next person to come in with the next dollar to push it higher.
That's an excellent point.
And hey, stimmy checks are coming, so there might be some of that capital and availability. But I'll tell you this, a lot of people learned a lesson from that too. And if you bought it at 375 and it's trading 52 now, on the way up when it hits 375, I don't care how diamond your hands are, when it hits 375, because of that whole roller coaster, you're going to probably start to think, all right, maybe I should sell it at break.
Yeah.
Right? And
so I mentioned just a second. Oh, sorry, Dan. Go ahead. I'll let you get some questions in.
I was going to say we've blown past it a little bit, but we were speaking earlier about expectations of gains and how, like, trading options to make 800% in a day is just completely bonkers, stupid, unrealistic. What would you consider to tell a beginning trader, like, what's a reasonable expectation of being able to grow through trade? I say we do every other day trading because I'm not looking to buy and sell on the same day, but I will sell the next day or the next week. What do you think? Where should expectations be set for someone that's learned enough to be playing the game, but still not a seasoned pro?
Yeah, that's a fantastic question, because I think this is where we start to unpack like the real learning lessons of the last month or so. And so when our traders start out and they're brand new, because I think there's people who are listening who are brand new, and then ones who have some experience now with this event. If you're a brand new trader, think about this. It's your day one on the job. Any expectation you have on day one is wrong. Like, you don't really know what you don't know. So just showing up with expectation to something new it's a losing proposition. You're never going to be right, and that's just going to kill your confidence. So if you're brand new, rather than expecting the profit, put an expectation of learning. Be like, look, today I'm going to learn just a little bit more than yesterday. Evaluate yourself on what you learn, and then that's going to be a lot more profitable to you in the future than to set an unrealistic expectation, which you're not going to hit anyways, and now you're disappointed in terms of how you're performing. But in reality, you're probably performing better than 90% of people if you look at how you're learning and progressing. So for brand new traders,
yes,
you set a target of, I want to learn. If you start to do this thing and you're getting a little more consistent, you have some experience, a couple months behind your belt. In our options trading room, when we have a 30% gain, we take 1/3 of the position. Some people take off a half. And then what we do is we take the stop loss, put it to break even, and then we turn it into a runner. So the goal here is, let me make 30% of my capital, because to new traders, it sounds like peanuts. 30% is a great return. It ain't nothing to laugh at.
That's awesome.
Yeah.
I can't believe I got to say that, but it's 2021. 30p is really good. So you take initial at 30%, and then you let your runner work for you. Let your position work for you, but not at full risk. Is take the risk off, reduce it, get paid, and let the rest of the position make you risk-adjusted returns. It's not about making $1 million. On the professional business, when you're funding traders in a proprietary environment, you look at two traders, one that's up $1 million and one that's up, let's say, $50,000. The people would think that the one that's up $1 million would get hired, but that's not true. They'll ask to look at the variability of your returns. They'll ask to look at the risk. And so you got to think about it from a professional industry. If professionals are hiring traders who have risk-adjusted performance, you should try to replicate that by having risk-adjusted performance yourself. And so that's a great question. The quick answer to that is, if you're new, expectations are only going to hurt you. They never help. If you have a little bit more experience, set a number, 30 to 40%. Each stock varies. Some of them are more volatile than others. So, that's where your experience comes in, and you can actually now set an expectation. We like 30%. A lot of the names we trade will have about a 30% movement in the options market, and then we lock the rest of it for a runner.
I like that. I think one of the ones that I've been doing lately is I usually go with half. If I see it double, then I sell half my stock and then just keep the rest, because I figure you can't lose anymore at that point. But I felt like that was probably too high, but I'm glad to hear that 30% is actually pretty reasonable. So I will be adjusting my points. Yeah,
it's a good start, right?
I'll be adjusting my points for sure.
Hey, if you're trading and you're making 100%, if you're seeing options going up 100 on a consistent basis, it's nothing wrong with even going that high. It's just when things drop to 60%, there's no reason that you should still be targeting 100 when the average returns are 60. Right? I think this is where the trouble happens. Is people are like, I want 100%. It's great that you want that, Can I swear on this podcast? Just
yeah.
emphasize a point or no? All right. You might want, 100%, but the market doesn't give a shit what you want. It's going to wherever it needs to go.
That should be clear. That's not a hard set rule or anything that I do. Like, I'll definitely take 20% even if it looks like it's kind of tapering off at that point. Just if I hit that 100% point, then I'm selling half right there, and then the rest of it to me is now just, you can do whatever it wants. I don't care. I could sell it, for 2 cents and then still make money on it.
Yeah, and sorry, I wasn't like targeting.
No.
I'm just the newer listener who's starting out. I know for a fact that your risk management strategy is more like dynamic.
Mm-hmm.
One number doesn't mean anything. It's let's see what the market gives us.
Mm-hmm.
But it's also nice to have a strategy and approach. So hey, if you're seeing that 100% are hitting, why not, right? You could peel some off at 100, then trail some. But then we always need to be ready as traders to adjust the new market conditions. Because what the markets will do every so often is they'll put in a certain trend until everyone notices it. And then when everyone notices that trend, it's done. It'll never work that way.
Is that why it works till it doesn't? It's something I've been finding.
Yeah, it's like, hey, look, the stock market is like more efficient than any one of all three of our ex-girlfriends put together. It's separating capital from like overly ambitious, uneducated people. Even myself included. When I started, I've had a lot of girlfriends before. I had to say that a little bit quieter. The wife's downstairs, but the market knew how to take the money out of my pocket the quickest. And it's like that by function, right? It's like that by functionality. Like even look at the hedge funds versus GME traders. So they almost brought down Melvin Capital. We don't know yet. We're going to see what ends up happening. But then there's other hedge funds that made $700 million plus. Right, in the same type of event.
Yep.
So it's like there's these short-term exploitable moments, but on average, it's harder to win than just pumping one stock, getting out of it. And I hope that your listeners and anyone that traded didn't get burned enough and learned their lesson cheap. But even if you learned it expensive, it's still a lesson. We control how much we pay for lessons in this market.
Well, and I think we were pretty clear that if you're going to, when this whole thing was going on, that this was not something you put your life savings into. If you want to take a bet with some of your earnings that you've already, some of your profits you already made, have at it. But anybody that was
the lotto ticket,
anyone who's asking me if they should invest in it, I said, don't put anything in there that you're not willing to lose, because you probably will lose it.
Yeah, exactly, right?
I bought my shares as a badge of participation. I don't expect to ever sell them. I want them to sit in my account and be like, yes, I was there, sonny boy.
I've been waiting for it to come back down because I actually believe in the GameStop long term. I like what they've done with getting Ryan Cohen on the board, and the flexibility of that company. A company that makes $1 to $2 billion in revenue every quarter, it has to have some value. It's got to be worth more than $8 a share, which it was before. But if Ryan Cohen can turn this around and turn it into the Amazon of the gaming world, which is what his plan is, I plan on buying back into it again as soon as everything kind of stabilizes.
But you know what the craziest part about that is that GameStop didn't really profit much from this. No. I was actually shocked to see that GameStop executives held on to all their options. I got to tell you, that's like fantastic management.
I think they had to.
You look at the CEO. Yeah, well, I mean, look, I'd be tempted. If you see some of the gains on Reddit, imagine being an executive having like all these shares. Like, oh my god, what do I do?
Ryan Cohen's stake, I think, was worth $3 billion after he, at one point, and he held on. So yeah,
kudos to them. I don't know if it was a legal obligation or not.
I think it's more of a PR thing. They finally got some great PR if they were to just start cashing out at the expense of this perceived movement going on.
Kudos to them, because temptation's there. You know what? $2 billion, take it out as profit. Who cares what PR nightmare you got? You go to Dominican, you live a great life or somewhere. You know what I mean? I like that. I think GameStop demonstrated that their management is like exceptional through this event. And so, but now it goes back to a longer term picture, right? We know that it's not going to hit 1,000 overnight, but now it goes back to like, hey, let's look at some of the fundamentals and the potential for this company to actually earn revenue. The picture gets reset back to a longer term plan versus overnight pump, and then see if we can make $1 million.
You mentioned not profiting off of it. AMC actually managed to, didn't they? I thought I saw they converted about $600 million in debt and staved off bankruptcy.
You know what? To be 100% honest with you, I haven't looked at that or kept track of it on the AMC. I'm like my trading style isn't as much fundamental. It's more so like get in, make some money, and get out, which is surprising they didn't participate in this. But I'll tell you what, when I saw it going up and the mentality of it, I didn't like it because it kind of made a little bit of a mockery of our business. Look, I say this with, I'm super excited to see each and every person who was part of the GameStop rally participate in this market because it was newer traders.
Right.
And I love to see new people come into this business. It's done wonders for my life. And I think everyone should invest. But on the flip side of that, I don't think a lot of people realize this. There was almost a systemic collapse in the markets. I'm talking 30% downside based on my calculations of the entire stock market just because of these stocks. Because you bring down a hedge fund, guess what? That hedge fund's got capital that it borrows from another hedge fund. You're bringing down a second one, a third one. You screw all those hedge funds, and you're like, I won, but now your grandma's pension is done. Your mom loses her job. S&P drops because these hedge funds lose that money. What are they going to do? They need to have a margin call. They got to come up with money. What they do is they start selling the Apples, the Facebooks, the Microsofts, the Googles, the Amazons.
Yep.
And that's why you see these short float stocks pump up, but the whole market's just losing confidence, deteriorating, and getting hammered. We were on the verge there of something chaotic happening. And, I remember I was sitting there looking in the trading room, and I had like a wave of sadness to me. I don't know. I've been in this game a long time, and it's just like, I was like, I know how this is going to end. I didn't buy it, but I wasn't stupid enough to short it either.
I'm actually glad I wasn't in the industry like you were in 2008-9 because I actually look forward to those dips because to me that's just another chance to get things at a discount. But yeah, you make a good point because they forget about all the actual lives that are tied to this.
Man, like it's, there's a fine line between it being a business and then seeing financial ruin. Like in 2009, I was doing really good with my day trading, and the money was there, but you go out and the whole mood wherever you go is just doom and gloom.
Right.
You know what I mean? It's like you did good, but it doesn't serve you to be good yourself when everyone else around you is doing crap. And this might seem extremely like happy guy, happy-go-lucky, and people might not believe this, but the money that I was generating wasn't enough to offset the pain I was seeing it causing to other people. And I had to deal with it. I was on the phone. I heard people's stories, people that would call me to get quotes on a daily basis because back then there wasn't as much availability as information. Like there was no trading view. They had to usually call a broker, and I'd pick up the phone and give them a quote. And people who I knew about their families and all this stuff from phone calls just getting absolutely annihilated. And, we forget at a certain point that the people who have the biggest interest in financial markets are usually the people we forget about the quickest. Pension funds, all right? Like a lot of teachers' unions, like, a lot of people who are heading into retirement have the most amount of exposure. So yeah, we almost brought the system down, but at the same time, we almost brought the system down. You know what I mean?
Yeah, who's that going to hurt? Yeah, do you feel like this was retail-driven event, or do you feel like there was some institutional money pushing the other side of the short on GME, buying up, knowing they'll cause a squeeze?
I think it was both. I think that's a really good question, and there's no way to really confirm it, right? I know that retail was responsible for igniting it, and I wouldn't be surprised to see some hedge funds seeing an opportunity to screw one of their own to kind of jump in as well, because, hey, it's a competitive industry, right? At the end of the day, it's like money just competes. And so I think it was actually both of them. I think early on, the hedge funds who got, who saw the opportunity first probably put some money into it, but they were probably the ones selling on the way down too, rather than holding it, right? So yeah, I honestly think it was a two-part participation there for sure.
So what's GameStop short interest at right now? I think the report just came out on the 9th. I thought it was somewhere between 40 and 50%.
Yeah, which is still high traditionally, right? Anything above 30% is like a high short float.
Now,
the fact that it got over 100% was ridiculous.
My question to you then is, how accurate are those numbers? I know that they're delayed. I mean, the numbers that come out on the 9th are actually from like the 29th of January, so there's like a 2-week delay in there already.
Well, like this whole thing with having to report these positions, it's an honorary system, but it is also legally binding. As a large spec trader, you do have to report these obligations. And, this short float interest is a combination of everyone that's short. It's not just the hedge fund industry. It's other people who open shorts. So it's reliable to an extent, but when I see it as 50%, it isn't. The exciting thing about any stock having a short float over 100% is that theoretically, there will never be enough shares to close that short. The price could get to infinity, right? Because if you send everyone chasing to close the short, they can't cover 122 apples worth if there's only 100.
Yep.
So I think that's where the excitement got in. Like, hey, let's actually take this thing to the moon. And, you know, it's that 122 figure. You look at how that's possible. That's the brokerage industry to blame, right? Like, what they do is naked short selling. They'll actually allow somebody to short sell without finding a client who already owns that in their book. So when GME started to ramp up and everyone started to get excited, some people wanted to short it still early on in its rally up. And they call their broker, and their broker says, you know what? I don't have anyone that has it that I could lend it to you for a short position. But my God, I could make a lot of interest on this. I'll tell you what, I'll just let you open a naked short. And that's how you create shares out of thin air. You know, and the SEC is now looking at, oh, let's go there and start to hit these Reddit guys. Like, you know, this is a coordinated pump and dump. Let's see if there's any legal action. Let's get that deep effing value guy. Let's call him up for a testimony. But we're not talking about what actually created this as a short squeeze. This started as a good investment. You know, buy it into the retail season, get some consoles coming out, let's make some money. But now it's like, we got to ask the questions of the brokerage industry too. How are you lending out so many shares that you didn't even have? You know, we got to point fingers.
I think that actually kind of leads into my next question then, which is about the fails to deliver. And seeing things floating around on there on Reddit about there being a high number of fails to deliver on GameStop. So my understanding is that is the number of shares that were sold but could not be delivered, I think. Could you explain that, like what that actually is?
They were
so
naked shorted but never covered.
Exactly. So it's like you're naked short, and so what ends up happening is you have your clients who are short positions who then want to cover their short, and they're looking to buy it, but now you got to find somebody willing to sell it to you. And so as a brokerage, you're in a what we call in the industry an undisclosed short position, which means yes, your clients have these trades, but you as a brokerage now have underlying risk. You have liquidity potential issues that can happen. And so they're out there trying. I mean, if you guys read on how the hedge funds actually close out their shorts, I thought that was genius. I mean, we could chat about that in a second, but this is where brokerages end up being net short on their whole book. So if you think about how they do business, you have Peter who owns 100 shares of Apple. And you got Larry. Larry's absolutely nuts. He wants to short Apple. So what happens is Peter lends the shares to Larry for the short. And so you got Peter 100% position long, Larry 100 share position short, but they're offset because Larry owes the shares to Peter. They're tied 1-to-1. Net effect of the brokerage is 0. But that's not the situation they put themselves in. Right, and I think that's where regulation could look at it and be like, how did you guys get yourself in these undisclosed and naked short positions? How often do you do this? Right, and like, let's stress test this, because if you're going to run and operate on this business model, you know, you could have caused one hedge fund to go out, and that's not a problem. You know, if you're taking risk in the market, and if you're taking a lot of risk, you should be able to blow out. You know, it's like, that serves you right.
Yeah.
Right? It's the rules of capitalism. You want to go do something boneheaded, you got to pay the price. But if it's something systemic that brings down 1, then 2, then 3. So what I was saying here is that, like, you know, if it's just one hedge fund that went out of business, great. You know, I'm all for it. But it had the potential to hurt the people who are our parents or grandparents who are relying on the stability of the market for their passive income portfolios. Right. And I think that's what has to be looked at from a regulator standpoint. You know, you look at the deep fucking value guy on Reddit. I think there's going to be some interesting situations there too, because one thing people don't realize is he was actually licensed as an advisor at the time that he was promoting this on the forum. And so,
yeah, I did see something about that.
It's one thing to be just like John from like the trucking business talking about on Reddit. It's another thing to be a licensed professional in the industry, because when you do get licensed, you go through testing, you go through like ethics, regulatory stuff, training by compliance. There's a process to it. And so I think they're going after the wrong people, number one. But number two, there's got to be a review in how these brokers were able to create out of thin air 22% extra shares than there were.
Now, go back to the deep fucking value point that you just made about him still being licensed. From what I was reading, I don't know if this is correct, maybe you can correct me. It sounded like there was only like a short overlap over the time he was employed with this firm versus the time when he started doing his post. I thought I'd seen it was only like a week or two.
I'm not 100% certain, but I could imagine the overlap is the time between him making a couple $1 million and then quitting.
What?
Right? It's like if I'm gonna work from home, I could still be in advisory business. Like, holy crap, this is working. I'm gonna quit. But the point is, you started opening the trade.
Well,
and even though it's only a few weeks of an,
he started posting about that back in June, and the play that he was making had nothing to do with the short interest on it. He just believed in the company as a whole, thought it deserved more value based on the fundamentals.
He took some profit. He made an enormous amount of money. He could get some good lawyers.
He made about $13 million, yeah. Yeah.
Yeah, he'll be good with it. I'm sure he'll prosper and come out the other side. But they are looking for somebody to take down, right?
Yeah, it shouldn't be him.
Yeah, I agree.
You definitely need to take a look at like you said, the naked shorting, these fails to delivers that are through the roof on GameStop.
I feel like the financial system for the first time felt the effects of the retail trader winning, right? Because the system as a whole, we like to believe it's rigged against the retail trader, but that's because a lot of people start out before they're prepared. I think you could access the same information as the system, and I think this is the first time they felt a serious threat where, look, the everyday person is amassing a lot of power. And I think that's a beautiful thing. I think if everyone decided to do some investing on their own, you got the potential to change the shape of what the world looks like tomorrow. Never mind making 10, 30x on GameStop. Think about the influence you have on what products you support, what industries, what trends. At the end of the day, a vote in politics is less meaningful than how you vote with your dollars. That's how you really shape the future. And I think in the end of all this, it's fascinating to see young kids getting into this market. I just wish there's a little bit more of a learning curve before they got to this moment.
Man, I swear you must be reading our notes or something, because you keep segueing into our questions here just beautifully. You mentioned the retail investors thinking that the system's rigged. What obstacles do we actually have as retail investors to overcome when we're going up against the institutions?
It's a fascinating question. There's one of the things that's easy to kind of point out is technology. They have more money, they could build technologies, etc. But I think the one part that really helps the institutional crowd win is experience and knowledge. And I think it's also the one thing that you can't really shortchange, right? Like, you could read all the books in the world, but none of the books had GameStop in it because it never happened yet. And so it's like there's something to be said about screen time. And I know that, institutional people have more money. They could buy bigger technology. They could buy better widgets than us. But at the end of the day, they still have to execute on the open market. And so I think the one advantage they have that is real and not perceived is the information. They can actually hire people. Be like, look, we don't want anyone with less than 30 years experience. Now you're going to go up against a firm with people with 30 plus years experience. And if they have that kind of money, they could do it. So I think one of the biggest advantages they have that we could replicate is information and screen time. So you're not going to be able to take down or compete against somebody with $1 billion portfolio today. But Warren Buffett didn't make his first million till he was 40 or something ridiculous like that. Or his first billion, it might have been.
I think it's billion. Yeah, that. He started with 5 million, I think.
Yeah. So there you go. First billion until he's 40. And now look at him. Now, he doesn't even know how much billion he's got because you don't have to after a certain point.
Yeah.
So,
right.
No matter where you're starting, I think if you start slower and look to build information, nothing replaces screen time. So to the retail investor, we might feel like we're disenfranchised because I'm a retail investor too. But I could tell you this, you can win. You can win against bigger money. You can win against people in this market. And you don't have to do a short squeeze moment like GameStop. You don't have to serve it to them in one day and take their head off. You could start by putting in little jabs over a longer term.
Take the body,
and
right?
So I think, the retail... Yeah, exactly. Hit the body, wear them down. You don't have to be biting ears off like Tyson. Just go for the solid, consistent jabs, and you're not going to make any highlight reels in that fight, but you're going to take them out, and that's what matters at the end. It's like successful investing for the long term is not sexy. It's not exciting. It's calm. It's rational. It's risk management focused. And those are the things professional traders use that I think retail could incorporate today. And by incorporating that, you will start to beat them. I mean, look at the money management industry. There was literally outflows this year. Hedge funds have been losing since 2016 because they keep shorting the market. All right. Instead of getting people managing your money, now these index funds are helping the everyday person invest in every stock instead of having to pay 3% of their fees to have their portfolio managed.
Yeah.
We're already winning. We've shaped the way finance looks. All right. It's just we got to keep winning with information in the long term. And one thing I want to mention, the last thing here, I know I'm kind of giving you some long-winded replies, but I get passionate. I've had a lot of caffeine.
That's all right.
Is the hedge fund industry is interesting as a target, right? Because you guys remember the movie The Big Short?
I actually didn't see it, but I'm familiar with the concept.
Yeah, it's like they described how the housing market got brought down in like a cool, like millennial way, you know, like I forget the actress name, but she's doing it in a hot tub, like explaining what a CDO is in a fun way to. And we look at that and we're like, wow, these hedge funds were able to call the top, and they were able to bring justice to the market of what these banks are doing. Fast forward, 7 years later from what happened. I mean, the movie didn't come out 7 years ago. It came out late after The Big Short actually happened. Right. But fast forward a few years later, now the hedge fund is the one taking the brunt of it. And you look at the hedge fund as an industry, I think Melvin Capital unfairly is personified as the hedge fund industry. I think there's so many other hedge funds out there who actually serve a very key function in markets. They prevent investors from buying crappy stocks that are frauds by spending. And you look at this, you say, yeah, obviously this company is going to publish a crappy report because they're short. But at the same time, think about how much money it costs to research something like that. Like those companies like Sino Forest that were complete frauds. That costs millions of dollars to get boots on the ground, get drones flying, get reports, buy like tips from people. By the time you purchase the report, you're like $10 million deep. You should make some money if you're right on the short side.
You make it go. I mean, shorting, I think, is still, it's not something that I'm against like an Elon Musk. I think it definitely serves a certain purpose. I think the problem that the majority of the everyday people have is when, you keep seeing things popping up where it looks like the hedge funds are shorting these companies that are actually, not bad companies. They're just shorting them into the dirt and causing some of these things to go out of business before they even had a chance to really succeed or fail on their own merits. But that's not going to be everybody. Obviously, there's going to be bad apples in just about in any industry.
And I think that's the only part that at the end of the day we could bring up is that in both sides of the picture, no matter how polarizing the situation is, in both the retail industry and then the hedge fund industry, there's people that mean well. It's just we pick the examples of the, look, we had fun at TradePro and we came up with an idea to come up with a sweater that says Melvin Capital Risk Management Department. That's how funny would that be? Somebody there screwed up. Let's have some fun with it. But there's other hedge funds who made money who were like, hey, I agree with the retail guys. Let's squeeze these people's head. Like they got themselves in a position they shouldn't be in. Let's make them pay. And so as polarizing as it was, I think it was a good event for the world to learn. I'm happy that it stopped short of causing a collapse because I thought we were close. Like I was modeling things out. I'm like, we're like 3-4 days out from massive margin calls.
I think it might have actually been closer than that, according to one guy I was reading from. I mean, he said we were like minutes away when RobinHood put the kibosh on allowing the GameStop trades to continue.
For RobinHood, for sure. I don't think RobinHood will ever tell you this. And again, I don't know this, so legal financial disclaimer, do your research, blah, blah, blah. But I think they were close to going bankrupt. Here's a CEO saying we don't have any funding or liquidity issues. And then 6 hours later, a headline on Bloomberg, RobinHood draws down $1 billion worth of their credit lines. That's interesting for a company not having liquidity issues.
And then raising another $3 billion a couple days later.
Which is more than they've ever raised at a cumulative basis. Right. So it's like they're having an issue. And I think, RobinHood is sometimes unfairly hit hard as well on the fact they restricted. I think they either had to restrict or they would have blown out. Because a lot of people don't realize this. When you're using a margin account, when you buy a position, you actually don't own the shares. The shares are owned by the broker,
Right.
held in trust under your account. So if Robinhood would have continued to allow these orders to go through and they couldn't post the liquidity requirements with their clearinghouse, they would have had to go bankrupt. And so instead of lose all the money for everyone who, you would have got pennies to the dollar as a return. I'll tell you this. Thank God I wasn't in that position. That's a hard decision to make either way, right?
Well,
Yeah, there's no right answer.
the other side of that too is that I think Citadel is the clearinghouse that Robinhood uses. That they send, I think, 40% of their orders through, or the majority of them. Is that correct?
Yeah.
Now Citadel also has another
exactly.
hedge fund that they operate too, right?
Oh man, Citadel has a hedge fund.
Right.
Like, Citadel at times represents 40% of all stocks executed.
Okay.
Good Lord.
Because right now there's more volume trading on the back end than there is on what's called the lit market, like New York Stock Exchange, etc.
Well, here's where the optics look really fishy to somebody like me, like a layperson. I see, from what I understand, like the reason why Robinhood got in the situation that they were in is because the margin requirements from the clearinghouses basically were raised when this whole craziness was happening. Is that correct?
Yeah, for sure. It's because of concentration risk, right? It's like you have so many of your new dollars going into these companies that if they do turn, you're going to lose. Like they have a VAR model, value at risk, and that's dynamic. It's like all your stuff is concentrating in a few names. If this happens, this is way riskier of a situation you're in than 3 days ago. So now we need 15% of that money, as an example, to guarantee these positions. That's a couple $2 billion.
Now, the question I have is that regulated, or is there any, can they just come out and say whatever requirement they want to? Is that all an internal thing?
So here's the interesting part. There's very few clearing firms.
Right.
So in the United States and in any marketplace, there are more brokers than there are clearing partners, meaning that multiple brokers will use the same clearinghouse. And, the dynamics of how that works, there's a regulation component of capital requirements, and then there's an internal policy. So the regulatory, and I don't know the limit of what it is, but if you have a concentration risk, you're going to be required, by the financial services, and these are all positions that are insured, by the way, in the US, right? So you're required to have certain liquidity requirements, but a broker or a clearing firm also has the ability to ask for excess of that from a policy standpoint. So legally, you're mandated to raise some, but then internally as a policy, you have some wiggle room as well. When we were a brokerage, we would make decisions on margin requirements. We'd be like, holy crap, this stock is getting a lot of news, a lot of volatility. Let's go from 30 margin to 60%, because margin is the amount of money that you're actually putting down,
Right.
not what you're borrowing. So then that would cause more liquidity to come into a broker account. So there's those two things that are at play. There's what's mandated by law and then what's policy internally. And a lot of brokers use the same clearing firm. So if one clearing firm goes bust, these brokers are going to have no one to clear with, and that's where the systemic issue almost occurred.
Okay, yeah, I can see that being really bad.
Yeah, it was close, but they have recourse too. How did you get yourself in a position that
Right.
you cleared 122%?
Yes.
Figure that out. That's some questions that have to be asked.
We're starting to run a little long here, Dan.
I wanted to at least get a chance to ask. Okay, so we've been talking about GME and squeezes and whatnot. I wanted to shift gears into what indicators do you look for in when you're going to open a new position? Like what tells you okay, this is a good time to buy?
Yeah, so the way that I do it is I trade futures, and options also has this component to it. I study order flow a lot. So in a way, the short squeeze and short interest to me is like my bread and butter. This is what I do, except I do it on a different basis. Like in a futures position, what I end up doing is starting out with levels. So I don't use any indicators. I don't use none momentum, no MACD, no RSI. I use price action. So I'm looking for the structure of the market. I'm looking for higher highs, higher lows. That indicates it's an upward market or bullish. And then I look to pick a retrace level where I could get long with some little risk. So the way I do that is I set levels. Be like, hey, look, we've had a run up to this price. It should pull back and stop at this level. But I go a little bit further because should is words like famous last words. It should do this. Boom, you get run over. It didn't. Oops. So what I look at is order flow. So price gets into that level, and instead of putting in a limit order to buy, I look at the order flow. So what I'm looking for is, how are these orders flowing through the market in real time? Are they trading on the bid or the offer? Because if you trade on the offer, you're a market buyer. If you trade on the bid, you're a market seller. And so I'm not only looking for that high probability level, I'm looking for the orders to start drying up on the sell side and start picking up on the buy side. And that's how I qualify my when moment. I wait for, let the price come down to my level. Now let the sell side wash out and the buy side show some momentum, and then get in. So I'm never buying the low. I'm always buying.
You're buying
a little bit higher than.
But you're waiting for the trend to reestablish.
Exactly. I'd rather pay higher for a high probability trade than get it at the lowest tick.
Yeah.
Be the one holding the bag if it fails.
Yeah.
Well, I think we've figured that out ourselves, that you're never going to get the peak or the bottom. So just wipe that from your head now and find points that you're happy with.
And if you did, it's luck. You know what I mean? Everyone gets lucky once in a while. Even a broken clock works twice a day.
We are broken.
Hey, like, I've been there, right? The only time I get the highest tick or the lowest tick is when it's a stop loss. If I have a stop order in there, I'm going to get that low tick for sure. You know, it's like, yeah, great. I got stopped out on the low. Yep. And people always say, oh, well, it happens to me as well. It's part of the game.
Happens all the time. It's like,
yeah,
it's a pain in the ass. I got a tip for that if you guys want. Like, if some of your listeners are getting stopped out, and then the price turns in their direction, a lot of the times we try to buy it too early because we think we're going to miss out on the opportunity. We're scared of missing the move. But wherever you want to get in, you have an entry and then a stop loss below, right? On the long side. Flip it and put your entry where your stop is. Because if you keep getting stopped out and it goes your direction, I know it sounds simple, almost over too simple. I know it could even sound a little stupid. But if you keep getting stopped out, put your buy order where your stop loss is and put your stop loss a little bit lower. You're just being slightly impatient.
Definitely.
And that alone's true.
Definitely patience is a problem of mine. That's a great point there. Yeah. I've ended up picking points and then finally just turning it off and walking away and figuring, you know what, I'll get it by end of day.
Yeah, there's a saying in our business, if you like the 200, wait, you'll get the 190.
Yeah.
That's awesome.
Man, I had some Canadian questions to ask you, but it sounds like you emigrated. So are you a true Canadian?
I am. Yeah, I've since 90. I don't know when I wrote the immigration. That's like early to mid 90s.
All right. Okay. My wife was wanting to know what the deal with Kraft Dinner is. Is it just the box? Is it just the box of Kraft macaroni and cheese, or are you guys adding stuff to it, or what's the deal?
This is a funny question. So it's like, Kraft Dinner is like the Canadian version of Spam. Well, no, you know what? That's not true because you can make it nice. I got through college on Kraft Dinner. I'm not knocking it. I remember I showed up to my what was the name of that? It wasn't calculus. It was like derivatives in math. I forget the name. Anyways, I was in engineering before I switched to financial stuff, and I would show up with like a pot of Kraft Dinner in my like pajamas to class at 8:30, 20 minutes late. So I'm not knocking Kraft. It's like instant noodles with just cheese, and people like it, especially people on a budget.
Right.
I was there.
All right, next question then. French fries. Do you use mayo or gravy?
Oh, so Canada is where the poutine started.
Mm-hmm.
This is fact in Montreal. So I love fries with gravy and cheese, but not always because that's like a heart attack in a box. I like gravy. Yeah.
Okay. And then the last one I had was what's your hockey name? Would it be Zavs or Paps or?
So in hockey, I do play hockey. If you ask like 9 out of 10 Canadians, they'll say yes because they do, and 1 out of 10 is lying. So, but in hockey, we got a way of like putting E at the end of everything. So
Donor.
My last name would be Pappy, like Poppy because it's Papazov, or G because I don't like these people calling me Poppy. I don't want to pay that much like childcare for people's kids. But like, I'm not your dad. I have a son already. But yeah, Poppy's a good one, or just G.
I was thinking Zoner or Zaver. Zaver.
Yeah, that's the other one. You add the ER. Yeah. So you'd be header.
Yep. Dan Lease.
Well, I don't know.
The leaser?
Leaser? Probably Leaser. Yeah.
Leasey?
Yeah.
All right. Well, should we talk about some of your? I mean, we brought it up in the intro, but we let you talk about your website, your YouTube channel, where people can find you if they want to hear more.
Yeah, for sure. I'll leave a quick plug here. I'm a big believer of you should get some kind of education. You decide what's right for you. I don't do these sales pitch stuff. Find a community and belong to one. It doesn't have to be ours, but be a part of a community. Mm-hmm. Anyone on the professional side doesn't do this by themselves. There's no one who does this and has fun doing it in the bedroom by themselves in the corner of the room. It's like, it's not meant to be done this way. So join a part of community, any community. At ours, at TradePro Academy, we have on YouTube a morning market update. It'd be fascinating for you guys to actually listen to the ones through GameStop. I was sitting there trying to talk to everybody, be like, look, take some profit, get paid. Like, there's no reason to be trading $4.75 and you're waiting for 1,000.
Right.
Wait with it with like a third of the shares.
Yeah.
Sell, take some profit.
Yeah.
And a few of our YouTube listeners tried to share it on Reddit. It got taken down. I try to, anyways.
Oh yeah.
I try to share the message, but sometimes when people don't want to hear it, they won't.
Probably called you a bot.
YouTube is a great. Yeah, they're like, you're a bot. This guy's from the hedge fund industry. When you have your mind set on anything, it's called confirmation bias. You only want to hear information that confirms what you're looking for. Mm-hmm. Great way to blow out an account. The way that I do it when I invest, especially for longer term, not just day trading, I like that somebody will tell me, look, buy GME. The first question I ask them is, do you own it? Mm-hmm. And they'll say, yes. I'll be great. You're useless. I don't want to hear your biases of why you own it. I'd like to hear from somebody who doesn't, right? It's like, you clearly need me to buy it so you could go up for your position, but let's find somebody who doesn't own it and find out why they like it and don't. That's why I kind of do comparison. I don't know how I deviated here, but YouTube, 9 a.m. every morning. We have a free video. We have a free video for 10 to 15 minutes. I think that's a great start. We also have a podcast called Mind Over Markets. I think one of the things that make traders successful is their psychology and mindset. This isn't actually an information business. This is a psychology and mentality business. And the faster you recognize that, the better you'll do. Invest in your trading psychology for sure. I think on that podcast, we 100% focus on trading psychology. So those are the two resources I'd point at the listener to. And this industry could treat you really well. Just you got to find the right resources and the right people. And if you're a retail trader, you've just started out. You motivate me. You have motivated me to be in this industry for 20 years. I'm not doing this for the money. I'm doing it because I love to see the retail trader win. If I had to do this by myself, I would have stopped a long time ago. This is a boring ass business to do solo.
What? Okay.
I'm sorry, but this is why you guys got together too, right, Kyle and Dan? It's like it's so crappy to do this solo.
You need someone to talk to about it. Yeah, you have someone to share, to talk you off the ledge every once in a while, to share your big gains. It's definitely a social game.
Yeah, I bored so many people to tears. Just last week, my partner's roommate asked me something about GME. He's like, "So is GME over or what?" And I started talking. Yeah. Maybe about 2 minutes into it, she just grabbed my arm and she was like, "Dan, stop. He's heard enough." The answer is maybe.
Sounds
his
like
eyes
that scene
yeah.
It's like that scene in Groundhog's Day. Oh, I'm sorry. Did you mean to talk about the weather? Or are you just making chit chat?
Yeah. Oh yeah.
That's great.
Exactly. Oh well, it's been great having you, George. This has been fantastic.
Oh, this is amazing. Yeah. I have to do this one again.
Thank you, guys. Yeah, we could do a round 2, maybe like learning lessons from GME and how to like proceed forward. But at the end of the day, I'm really happy to be here. I'm really happy to chat with you guys, and I'm really happy to see what's going on in the industry. I think taking control of our finances is kind of the best way to gain more control, more influence in the general economy.
Oh, yeah.
You guys keep doing it, participate.
Oh, thank you.
Oh,
yeah, we plan on it. Until someone stops listening.
Right?
Yeah. I love it. We need people like the Kyles and Dans to come together and to cater to the market. So appreciate you guys for having me on. It was a fun chat.
Absolutely.
And hopefully we get to do it again someday.
All right. Fantastic. All right, folks. Thanks for joining us for the episode. We hope you learned a lot. We're really glad you came along for the ride and hung out in the shop for the whole time. Stay tuned. We're going to have some more exciting interviews coming up week after week. We got a full docket. and we'll see here about setting up a round 2 on GME lessons with George here in the future. But until then,
I'd almost like to bring him back to learn about some futures.
Oh, yeah. We'd love to crack open futures and Forex, but there's only so much time in a day.
I know, right?
All right, and with that, we'll ask you if you like what you're hearing, like and subscribe, share, tell your friends, tell your enemies, tell your pets, tell everybody you know, and happy trades.
Bye, folks.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks and the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.